What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 11th of 2018. Well, folks, I hope you all are having a wonderful day wherever you are, and today we've got a variety of different things to discuss in regards to crypto, equity, and commodity markets here in the Daily Update. For crypto, I want to spend some time not only to talk about some key indicators that I'm going to be watching, and I think you guys should definitely check out if you want to get a rough idea as to whether or not crypto markets are bottoming, but along with that as well, I want to share a really interesting story from over at CoinDesk that talked about how a group of guys have come together and created a $200 million crypto fund even in this bear market. And I want to spend some time as well to talk about their fundamental approach to investing. Outside of that as well, I want to spend some time to talk about equities and talk about not only some indexes or indicators that give us an idea of the confidence or exposure to equities that hedge funds have, but also spend some time not only to talk about the VIX, but also share an indicator related to the VIX that I've used for over the past few years to get an idea on the major cycles of equities. So we've got lots of things to talk about. Let's not push it off any longer and dive right into the update. So taking a look over here at cryptocurrency market, guys, or cryptocurrency markets, apologize for that. In this case, there's not much new, guys. Again, we're still testing around the lows. It looks like we are going to go to test down at the lows around 3,200 on Bitcoin. Now, again, it depends on what exchange you're looking at, but I'm looking at Coinbase, Bitstamp, a lot of the ones that aren't sharing that same Bitfinex premium. I think very well that we're going to see those levels retested again. And again, we could very well be going for the big even of 3,000. That's really my next target where I'd feel confident in seeing some optimism come in the market. But again, I'm not making any serious additions right now, guys. I've already gotten a decent amount of exposure towards these lows, and I'm going to wait to see if crypto markets can actually hold at a certain price range over the next few weeks. We've definitely seen a nice correction, but again, we have to remind ourselves that crypto markets, in this case, usually with these longer-term cycles, tend to have longer-term bottoms that can last anywhere from, 3 to 6 months in this case. So I think it's very important to keep that in mind. Going on real quick, I wanted to share with you guys that I recently did an interview with Mike Maloney. Many of you might know Mike Maloney from The Hidden Secrets of Money or many of his other works on YouTube. I was very excited to finally get this up. The podcast interview actually happened a little while ago, but we were waiting to line up a sponsor for it. However, it seems like people have really taken positive to it. It's one of our not only most liked episodes of the podcast, but along with that as well, we've gotten a really nice amount of views here for the podcast in a short period of time. But I highly recommend you guys listen to this. I know it's a little bit longer than my already long videos, but if you guys have the time for it, or if you're driving to work, or you're getting bored at work, definitely check out this episode of the Dashcast. It was extremely exciting, and it was an absolute privilege being a fan of Mike for over 7 years. So lots of interesting information in there. All right, enough shelling on my own content. Going on here, I want to spend some time to talk about market cap as well as market dominance. Again, as I mentioned, it looks like we're going to come down and retest the lows we saw over the past few days, even though we have had some rebounds since then. It looks like it's fading off, and again, the market has not found a clear bottom yet. We will definitely get a feeling over the next few weeks as to whether or not crypto markets are going to be holding at these levels. It's really a matter of whether or not we really test 3,000 and hold it. I would love to see a hold on 3,000, but at the same time, guys, I'm not going to be telling you guys to just swarm in and be buying at these levels. You have to, again, understand if you already have enough exposure at the moment and whether or not you feel comfortable at this level, or if you believe we're going to see even more dramatic decreases downward. So, again, just remaining patient here. Bitcoin dominance, however, is getting up towards the top here around 57%. Right now we're sitting at just around 55%. I think we could very well see at least close to a retest of those highs, but I don't think you're going to see a break higher than that. We've already seen altcoins pretty heavily corrected back at this moment, and I think that as we test for the 3,000 range, I think that's going to be enough to dent altcoins down a little bit in their market dominance and bring Bitcoin back up to around 56 to 57%. But from there, that might be an area where we start to see some resilience across the board on crypto. So again, keeping patient, not making any decisive moves. We'll have to see if that holds, and if we don't, I think you could see Bitcoin dominance rocket off towards 60% in that case if we really do get a breach on 3,000. Going on here, I want to share another interesting little source here that you guys should definitely bookmark, and this is called moonmath.win, but this is really basically known as the rainbow chart site, and this is a really interesting page that I got shared from a personal friend of mine in the cryptocurrency space that not only shows something in regards to compounding daily periodic rate, generally the compounding rate of return that you get on a daily basis, but along with that as well, some really awesome rainbow charts for the logarithmic charts here that we can see. One more in a shorter time frame, as well as one in the longer term, which shows kind of a curving pattern here in the logarithmic chart, obviously because over a logarithmic chart, making a 100% gain later in the future, 10 years down the road, and Bitcoin's price action is much different than at the beginning making 100% return. And obviously, I mean, it goes back to talking about that compounding set of returns in that case. So I really recommend you check into this chart, the variety of charts that you can actually find on this website. It gives you a good idea as to where markets might be at the moment, as well as getting an understanding as to whether or not prices for Bitcoin are oversold or overbought. And it's not something you should just use for the bottom here. You should use this, I think, in the future and keep an eye on it. It's not a telltale sign if something's oversold or overbought. It's just, again, one of many indicators you can use to keep an eye on things. Another thing I'd say as well to keep an eye on is obviously the BTC USD shorts on Bitfinex as well as BitMEX, the overexposure in regards to shorts. And in this case, guys, I was talking about this the other day in regards to the daily update, how we were starting to peak up here at around 40,000. Again, getting to that range where we tend to find pretty big liquidations on the shorts, and we start to see prices move up a little bit higher. Now, again, I'm not seeing the confidence as much as we've seen a drop here in the shorts. I'm not seeing that confidence show in price. However, I'm definitely eager to see, you know, with shorts being this high again historically, we tend to have price, those who are trading on leverage on the short side, a little bit on edge. And if we get a breakout here, you could see a big liquidation. So it's a matter of checking out here on price, coming down to see if Bitcoin is going to bounce off these lows. We've seen 2 times in the past here that Bitcoin has started to rebound and get some big buyers here on Bitfinex and other major exchanges. Seems like people are definitely keeping up around the $3,300 range. But again, could very well break below there, guys. I'm not doing any crazy TA here, not trying to sell you guys on what to do. It's just a matter of remaining patient and waiting for those key levels to be tested. Till then, I'm not doing any trading for my crypto exposure. So above all, guys, I want to make it clear that at the moment, I'm just not making any serious moves in crypto. It's a matter of patience because at the moment, as much as I think prices are really getting into bloody territory, and that's usually where I get eager, I've already gotten enough exposed positions at the moment. And along with that as well, I'm waiting for crypto to make a serious bottom. Sometimes, guys, it can take anywhere from 4 to 6 months, if not longer, to see these markets bottom out. So I'm remaining patient. Again, it might be cheap at this moment, but before I really start to average down or build up on my positions, I'm going to wait for an actual trend reversal. I want to see signs that the market is ready to make some gains, but I'm going to remain patient until then. Alrighty, so let's go ahead and talk about this really interesting story where a bunch of guys are coming together and creating a crypto fund that is going to be raising $200 million and investing in the middle of a bear market. Well, I not only believe that they're smart in regards to creating this fund now during a bear market, they actually had ambitions, if you read through the article, to do higher levels of raises. However, at the moment, they're sticking with $200 million during this bear market. And along with that as well, they have a really interesting strategy on how they're planning to invest. So if you go down here, you can learn the fund's name is going to be Yeoman's Growth Capital, or YGC. Potentially might be one of the next big funds in the space. But I really like more than anything their investment strategy for the long term. There's a lot of funds that last year in 2017 made a ton of money in the short term, and they've actually lost a crap ton and got overexposed to a lot of crappy ICOs and things of that sort. And it was because they really weren't focused on fundamentals. They were looking in the short term, guys. But I like these quotes from these guys, so I'll go ahead and read some of them. The first quote here from Johnston, one of the team members, says, "We honestly think this is the perfect time to launch a growth capital firm that can take all these great technologies built in the past few years and help bring them into enterprise and to mass adoption by consumers." So it's not only a noble cause here, but I'm glad it sounds more than anything like they're actually trying to build something for the long term here, unlike a lot of the funds in the past. Down here from Lou, I like this quote as well, kind of going down the same line. "It's a good time to launch this because we are focused on growth and adoption. And in these bear market conditions, people see the very pressing need for traction or adoption. Something we have been preaching for the past couple of years." So it not only seems like they've been in the space for a while, but again, that they're actually looking to build something long-term and fundamental. They're trying to build some actual revenue streams, getting real corporate adoption on blockchain. And you can actually see as you go down here, not only do they talk about how they'll be able to partner with a variety of other portfolio companies that they're invested in. But I really like this whole kind of philosophy of what they're tackling. They're not only keeping diversified, but they actually want to kind of hopefully pair in some adoption from the companies that they're invested in. So you can see here, you can sort of think about this as almost a technology stack where we're going to run these growth plays, and it won't just involve one project, it might involve 3 or 4, says Johnston. So you can imagine us working with a telco or a telecommunication company, an exchange, a wallet, and a protocol to provide some new service. So they want to actually build kind of a conjoined service. They want to build revenue models. I like the big picture view here. This is something that's a little bit unique, whereas a lot of people are just investing in the next big ICO, and then one week they're pitching the next big ICO, and really they're just flipping through altcoins. I like to see that these guys actually want to build something. So hats off to them. Hats off for getting bullish. And when when it's not only a bear market, but when there's blood in the streets, I think it's smart in that case that these guys are going in. Best of luck to them. And again, more than anything, I'd like to see more of this, in this market, more long-term thinking. But just thought I'd share that. Thought it was pretty interesting and a good little bullish sign that you can start to see some institutional capital flowing through even in a bear market. All right, so let's go ahead. Let's talk about equities, guys. I want to spend some time to talk about the fact that there's a lot of hedge funds that have yet to dump in this market. And this could also be seen as a positive and negative thing. I think Bloomberg, to be fair, even as a bear here in this market, as someone who was bullish for years and is now a bear, I got to be fair, I think they kind of made this sound like a bearish thing, but I'll actually mention how it can actually be quite neutral or be viewed both ways. So the major point here in the article here is really focusing on a key index here, the HFR XEH index, which really shows the exposure of hedge funds to the S&P 500. And what's really interesting about this is that even though we've seen a sharp decline during the summer of 2018, we can actually see that hedge funds exposure right now is actually well above the lows of early 2018, where we started to see some pretty dramatic sell-off in price. Now, it's pretty obvious, guys, prices have not come all the way down to the 2018 lows as of yet, or at least they're not there right now. And along with it as well, because of that, I think as well it's important to notify that this is not so much a bearish indicator. All right. Now, what basically the case that they're making in the argument is that because hedge funds have yet to sell off their positions, because they're still so exposed, that if they start to sell and get down to this range again, equity prices could drop even lower. And that is true. I think that's something we need to be concerned about. So I'd be watching if there's a way you can actually get the source for this index outside of Bloomberg. I'd be watching to see this reach below 0.4 because that seems to be where we saw a breach previously in the past. But along with that as well, I want to say that this actually proves that hedge funds are more exposed than they were back in the early part of 2018. In fact, almost double the exposed of what they were. So again, something to show here. If this continues to hold up, it shows that hedge funds are still taking risk in this market. As much as I think that we're preparing for a bear market, as much as I think it could come back down to this level, if not more, as hedge funds, as well as other indexes for hedge funds like the Smart Money Index are showing that they are getting out. It's key to understand more than anything, guys, that you shouldn't take these indexes or these indicators as foolproof of anything. There's no real way to measure hedge funds exposure. In this case, this indicator, much like the Smart Money Flow Index, which we've talked about before, are ways to get a general idea of hedge fund exposure. Okay, so I'd say in this case, to keep an eye on this, to keep an eye on a variety of indicators. I try to give you guys these things because I believe they're one of many different indexes and indicators that you can keep an eye on to get an assessment of where you feel markets are heading at the moment. But really, until we see a major breakdown on this, I'm not really going to hit panic mode just yet. I think we need to see hedge funds definitely sell off a lot more before we really get too on edge on markets. But I think with the pattern that we're seeing within the NASDAQ and major indices, I think that's going to come soon enough, in my opinion. All right, so next up, I want to spend a little bit of time to talk about the VIX because the volatility that we're seeing in equities really tells the story, not only in the short term of equity markets, but also a very big trend shift in the long term. And we're going to spend some time talking about that. I think you guys really find that interesting. But to focus in on the short term, we can obviously see that markets are on edge. If we take a look here at the VIX over the past 2 months, the VIX has been making a higher base around 16 points and has been bouncing between the 24-point range here, really 25 points if you want to be precise. But it can show that markets, much like we've seen in the prices of equities, have been bouncing up and down. And we've been building higher bases every time. This is very distant from the low levels we saw on the VIX back during the later part of 2017 and the higher base that we built here in 2018 at 12 points. And now we're starting to test higher regions and holding it for a decent amount of time. So this really speaks to macro factors, guys. This is understandable, and it's actually rooted a little bit in some fundamental concerns. So let's go ahead and read some of these. Many of the core macro uncertainties don't have the greater clarity that was anticipated at this stage. For example, things like the trade war, which have been brewing since 2017, have only gotten worse in this case. Tariffs are rising on both sides. Along with that as well, Brexit, which has been brewing for the past few years, is finally getting to a point where the resolution that's looking like it might come through is not pleasing either side of the equation, no matter where you stand on Brexit. And Italy, and out of all countries in the EU, is still remaining as a weak link in this case and could provide as one of the many dominoes, much like Greece was back a few years ago, for the EU. So there's a lot of things that, again, we've been talking about some of these months back on the channel. If not, there's things that have been something that markets have been factoring in for over a few years now that are still, leaving markets anticipated for, what's to come. And this is also stepping into a period where we're not certain as to what the Federal Reserve is going to do in regards to interest rates. And it could paint an entirely different picture. So this is why in the short term, we're starting to see this volatility, even though, to be fair and to be a little bit more neutral here, corporate profits are still at record highs, meaning that equities can still be propped up by stock buybacks. Even though global growth is slowing, it is still holding steady. And along with that as well, we still got stimulus going on in China, as well as the stimulus of cheap energy prices. So there's a lot of positive factors as well to factor in, but I think these have started to outweigh the positive factors and leave markets on edge. And if we start to see one of these dominoes go into effect, a growing trade war, no deal on Brexit, or not only Italy potentially facing some economic issues, but also a massive set of Fed rate hikes, we could start to see markets really start to take a hit. Now, in the short term, this speaks on making a little bit of sense out of this volatility and this growing level of support for volatility. But I don't want to actually focus so much on the short term. I want to focus on the long term. There's an indicator that I've used for the past few years and I've been watching on for a long time, and I think it's finally starting to show a sign that we're setting for a longer term correction. Now, what is that? Well, a lot of people tend to simply just look at the VIX itself, the index's numeric value. However, I actually like to use it in compound in the longer term with specific indicators, predominantly the moving averages. And it's not very complex. You guys can set up this chart on your own, and I'm going to go ahead and show you guys how to do it. First off, you want to get your time frame to the monthly here. This is going to give us decades worth of price action, decades worth of VIX movement, in the sense sensing volatility over a longer period of time. But I'm actually going to hide the underlying price action. And I'm going to turn on my moving averages here, the 50, 100, and 200 MAs in this case. So we can see here the green line is the 50 month. We can see the orange line here is the 100 month, and the red line is the 200 month. Now, the key thing I want to do as well here is overlay the S&P 500. And you can do this with a variety of other indices if you want to use the NASDAQ or the Dow Jones. Your choice. You go wild with it. Make it yours. But outside of that, I want to spend some time to talk about how volatility over a longer term trend can be a sign that markets are starting to top, that markets are starting to prepare for a correction. Now, the major thing I'm going to be emphasizing here is that when the 50 month, this is really the key thing I'm watching here, not the 200 month in this case, nor the 100 month. I'm focusing specifically here on the 50 month. When the 50 month steps below 15 points, in regards to the volatility index of the VIX in this case, we can start to predict very well that markets are setting up for a more volatile period, that we're starting to see a trend shift, that we're going to start seeing a shift where prices get more volatile. Now, in most cases, and this is why I believe that this is an important indicator to keep in mind, when you start to see volatility increasing, as we saw here in 2007 stepping into 2008, we could start to see that this was giving us an early warning sign, even though equities were holding quite nicely towards their highs, that we were going to see a trend reversal. All right? And we're seeing the same exact thing over here as well as we step below this level. It is very clear that the majority of times this is going to be a sign that markets, especially after a major rally, are going to correct. I do have to be fair though. I'm not just going to nitpick things. We have to be fair that here, back during the dot-com bubble, during the 90s to the, or towards 2000, we saw the S&P 500, the Nasdaq, and the Dow Jones all have major rallies, predominantly the Nasdaq. And as volatility was increasing, price was increasing. And this is a key indicator, again, that speaks to the fact that volatility can increase during a bull run. So many people would ask, in this case, could we see a continued run up? I would say that it's a probability of 80% that it is not the case, meaning that we are going to see a correction. There is a 20% chance that we could very well see a continued rally in equities. And I think more than anything, I would be confident of that if we retested past the highs. But we're a ways away from that, folks, on the S&P 500. It's going to be a little while before we can really get back up to that price level. And that goes with all the major indices across the board. I think it's very likely that we're seeing not so much a repeat of 2008 as a recession. I don't think it's going to be so sharp and crazy, but I think we're going to have a slow, decent rise going into 2020, where volatility is going to definitely start picking up. And we're going to test towards this range again of an average around 25 points on the index. So again, this is something you guys can watch. It's one of many indicators that you can use to get an assessment of where markets are at the moment. But I think more than anything, this is an early telltale sign. The moving average is telling us that volatility is around the corner. And with prices being this extended, having one of the best bull runs in history, I think it's telling us that markets are a little bit on edge and ready for a correction. But I'll provide the one, devil's advocate case here. The only thing I think that I could actually see holding up stocks is some new technological breakthrough, some new economic technology that comes in to remove inefficiencies and provide more economic output. And what might that be? Well, it could very well be blockchain. That's one thing. As much as I'm someone who believes in the application and its use for currency, I don't doubt that there are some commercial applications. And who knows? Maybe blockchain does really become a major buzz topic again going into 2019 or 2020, and we start to see actual real commercial use case and have dramatic savings from it. Who knows? We might have to remain patient and see if that happens. Again, these are the early days of blockchain, so we haven't even seen the real ramifications and use case of blockchain in everyday solutions. So keep it open to that. Keeping an open mind, even though I'm a bear in this market. Love to hear what you guys think down below in the comments. That's going to be it for the daily update. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.